International Petroleum Corporation, IPC, traded primarily as IPCO on the TSX and Nasdaq Stockholm, and as IPCFF on the other OTC market, represents a compelling, high-growth investment opportunity within the global independent exploration and production (E&P) sector. The corporation is currently undergoing a pivotal financial and operational transition driven by the significant development of its Blackrod Phase 1 thermal project in Canada. Based on discounted cash flow projections anchored to the expected post-commissioning production and subsequent deleveraging, the current market price of IPCFF appears to substantially discount the intrinsic value of the Blackrod project and the firm's vast resource base. The current price of $15.79 compares favorably to the analyst consensus 12-month price target average of $25.58. This target implies a potential upside of approximately 62%, suggesting a belief among market analysts that execution risks are rapidly diminishing. The disparity between the firm's suppressed trailing 12-month TTM earnings metrics, such as the high price earnings (PE) ratio of 63.36, and its strong forward cash flow expectations necessitates focusing on future free cash flow (FCF). IPC is positioned for a major cash flow inflection point, moving from a period of high capital intensity to substantial cash returns once Blackrod is online. B. Key investment highlights. Organic growth catalyst is de-risked. The Blackrod Phase 1 development is progressing ahead of schedule, with the Central Processing Facility (CPF) construction nearly complete and first steam, first oil forecast moved forward by 1 quarter. This acceleration provides tangible evidence of superior project management and significantly reduces the typical execution risk associated with major thermal oil developments. Substantial resource base. IPC boasts 493 million barrels of oil equivalent (MMBO) in proved plus probable (2P) reserves, supplemented by an enormous volume of 1,107 MMBO in best estimate contingent resources, unrisked, as of year-end 2024. This ratio of contingent resources to 2P reserves, over 2-to-1, secures a massive multi-decade resource runway for future capital deployment and long-term value creation. Operational efficiency. Despite operating complex heavy oil assets, IPC reported competitive operating costs of only $17 per barrel of oil equivalent (BO) for Q3 25, marginally below management guidance. Low lifting costs provide a resilient margin buffer, crucial given the company's 53% exposure to heavy crude oil pricing differentials. C. Primary investment risks. Financial leverage. The corporation has significantly increased its financial leverage to fund the Blackrod development, shifting from a net cash position of MUSD 58 at year-end 2024 to MUSD 435 in net debt as of September 30, 2025. This MUSD 493 swing subjects the firm to heightened commodity price risk and interest expense vulnerability during the project ramp-up phase. Heavy oil price differential. With heavy crude oil comprising 53% of its production mix, IPC's revenue stream is intrinsically linked to the price differential between Western Canadian Select (WCS) and benchmark crude prices (WTI, Brent). Sustained wide differentials due to pipeline constraints or localized inventory buildup could negatively impact realized pricing. I. Corporate overview and strategic foundation. A. Company profile. And listings. International Petroleum Corporation is a Canadian-incorporated oil and gas exploration and production company. IPC is part of the esteemed Lundin Group of companies, a highly successful and influential entity in the natural resources sector. The corporation's common shares are listed on 2 primary exchanges, the Toronto Stock Exchange, TSX, and the Nasdaq Stockholm, under the ticker symbol IPCO. U.S. investors typically access the stock via the secondary over-the-counter market ticker IPCFF. The trading characteristics of the IPCFF ticker must be carefully noted. The low share volume and significant disparity between the bid and ask price indicates that the IPCFF listing functions primarily as an exposure mechanism rather than a primary trading vehicle for large institutional movements. This market dynamic supports the company's high quantitative uncertainty rating provided by certain analytics services. B. Geographic footprint and asset mix. IPC maintains a diversified portfolio of production assets and development projects across 3 key geographic regions: Canada, Malaysia, and France. The company generates revenue from the sales of natural gas, crude oil, and natural gas liquids, with crude oil sales serving as the key revenue driver. 1. The strategic focus lies heavily on its Canadian assets, particularly the ongoing development of thermal recovery operations, which require substantial upfront capital but offer long-life production profiles and scale, such as the Blackrod project and the successful Onion Lake thermal operation. C. Strategic pillars. IPC's corporate strategy centers on 3 primary pillars designed to maximize long-term value creation for stakeholders: organic growth, stakeholder returns, and M&A. The commitment to organic growth is exemplified by the aggressive funding and execution of the Blackrod Phase 1 development, which is expected to drive a significant increase in future production capacity. Regarding stakeholder returns, IPC prioritizes value accretion through share count reduction rather than immediate income distribution. The company returned MUSD 102 to shareholders through share buybacks in 2024 and announced the renewal of its normal course issuer bid to purchase a further 5.3 million shares through December 2025. Consistent with a firm in a high-growth, high-capex phase, IPC maintains a 0% trailing and forward dividend yield, preferring to reinvest all available operating cash flow into the growth project and share repurchases. The high total yield of 7.59% is thus entirely attributable to the aggressive NCIB. 3. Operational review and performance metrics. A. Production profile and composition. IPC continues to demonstrate strong operational consistency across its base assets. For the full year 2024, the average net production was 47,400 BOPD. In Q3 2025, average net production reached approximately 45,900 BOPD, successfully exceeding the midpoint of the full year 2025 guidance range of 43,000 to 45,000 BOPD. This ability to exceed guidance while simultaneously managing the complexity of major project construction, Blackrod, underscores the operational reliability and stable performance of the underlying asset base. Example, the successful infill drilling and sustaining well pairs brought online at Onion Lake Thermal in Q3 25. The production mix remains heavily weighted toward crude oil, which accounts for approximately 67% of total output. Heavy crude oil represents the largest single component at 53%, followed by light and medium crude oil, 14%, and conventional natural gas, 33%. This concentration in heavy crude oil is a key consideration when assessing future realized pricing and margin durability. B. Cost structure and efficiency. Operational efficiency is crucial for an E&P company, particularly one focused on thermal oil extraction. For Q3 2025, IPC reported operating costs per BOE of $17, a figure that was marginally below the guided expectation. Maintaining lifting costs below the $18 per BOE threshold is a strong indicator of effective steam-to-oil ratios and cost optimization across the thermal facilities. Low operating costs are paramount to insulating the company's cash flow from potential narrowing of heavy oil price differentials, providing a larger realized price cushion. C. Reserves and resource base, long-term value. The ultimate justification for IPC's forward-looking valuation premium rests on the sheer scale of its undeveloped resource base. As of the 2024 year-end reporting, the company held 493 MMBO of 2P, proved plus probable, reserves. More importantly for long-term investors, the company reports best estimate contingent resources, unrisked, totaling 1,107 MMBO. This large volume of contingent resources provides extensive optionality and a clear long-term development pathway well beyond the Blackrod Phase 1 project. The substantial resource volume effectively secures IPC's viability for decades, reinforcing the analyst consensus of a high intrinsic value and acting as the foundational support for the high long-term price targets. 4. Blackrod development, the core growth catalyst. The Blackrod Phase 1 development in Canada is the centerpiece of IPC's current investment strategy, representing the future driver of organic production growth and cash flow expansion. The successful execution of this project is the primary determinant of whether the consensus price target of $25.58 is achievable.
A. Project status and de-risking. IPC management has provided strong evidence of successful project execution, materially de-risking the timeline and budget. The latest updates confirm that the Blackrod Phase 1 development is progressing ahead of schedule. Key construction milestones are being met, with the Central Processing Facility (CPF) construction reported to be almost complete, and progressive commissioning activities advancing rapidly. Critically, the forecast for first steam and subsequent first oil production has been accelerated by 1 quarter compared to the original guidance. This acceleration in the Blackrod timeline is a significant positive development, as large-scale E&P capital projects, particularly complex thermal schemes, are notoriously prone to delays and cost overruns. The demonstrated efficiency in project delivery reduces uncertainty and reinforces investor confidence in management's ability to transition the company into its substantial future cash flow generation phase earlier than anticipated. B. Capital commitment and spend rate. The scale of the investment is substantial, with the 2025 capital and decommissioning expenditure budget set at MUSD 320. The financial burden of this massive undertaking has been concentrated in the recent past. By the end of 2024, IPC had already expended over 2/3 of the total forecast capital expenditure for Blackrod. In Q3 25, capital and decommissioning expenditures amounted to MUSD 82. This concentration of capital spending strongly suggests that the company is moving past the peak FCF drain associated with Blackrod's construction phase. The heavy front-loading of CapEx implies that future capital requirements will decline sharply post-2025, enabling the imminent conversion of operating cash flow into significant positive free cash flow, which is essential for rapid debt reduction. V. Financial performance and balance sheet analysis. A. Revenue and earnings trends, Q3 2025 review. The financial statements reflect a company operating under temporary but significant capital constraints. For Q3 25, revenue was MUSD 172, almost identical to Q3 2024 revenue of MUSD 173. However, the net result saw a massive decline, falling from MUSD 22 in Q3 24 to MUSD 3.8 in Q3 25. A similar pattern holds for the year-to-date figures. The 9 months 2025 net result, MUSD 33, lagged substantially behind the 9 months 2024 performance, MUSD 101. This profound divergence, stable revenue yielding dramatically reduced net income, highlights the high non-operational costs being incurred during the commissioning and debt servicing phase. The low net result is not indicative of poor operational performance, but is rather a consequence of increased depreciation, amortization as assets near completion, and rising interest expense associated with the new debt load. Therefore, current net earnings and associated PE ratios discussed in Section V are unreliable and misleading indicators of IPC's future value. B. Cash flow dynamics and capital cycle. Cash flow analysis provides a clearer picture of operational viability. Q3 25 operating cash flow, OCF, generated was MUSD 66. However, with capital and decommissioning expenditures totaling MUSD 82, the company reported a negative free cash flow, FCF, of MUSD minus 23 for the quarter. This negative FCF confirms that IPC is currently at the financial trough of its capital cycle, where cash generated by existing operations is insufficient to cover the peak capital requirements of Blackrod. Crucially, management noted that if Blackrod expenditures were excluded, FCF generation for Q3 25 would have been a strong MUSD 36, confirming the underlying assets are highly profitable and generating adequate funds. For context, the full year 2024 OCF was MUSD 353, resulting in a slightly positive FCF of MUSD 2.7. This demonstrates that the company is currently sacrificing short-term positive FCF to achieve substantial long-term growth. C. Balance sheet and leverage assessment. The most pronounced financial change is the dramatic increase in financial leverage. IPC moved from a healthy net cash position of MUSD 58 at year-end 2024 to a net debt position of MUSD 435 as of September 30, 2025. This aggressive debt-fueled funding of Blackrod has resulted in an MUSD 493 deterioration in the net financial position, confirming the firm's calculated willingness to take on significant leverage to accelerate the project. Analysis of financial stability ratios reveals manageable but tight liquidity. The current ratio stands at 1.18 and the quick ratio is 0.93. These ratios are adequate to cover short-term obligations, but they offer little cushion. Furthermore, the interest coverage ratio of 2.86 is thin for a growth-oriented E&P firm, emphasizing the financial pressure on management to successfully deliver Blackrod. The investment thesis must rely heavily on the projected massive FCF surge post-Blackrod commissioning to facilitate a rapid deleveraging trajectory and mitigate current financial risk. V. Valuation and shareholder return potential. A. Current valuation multiples. IPC carries a market capitalization of $1.76 billion, with 111.70 million shares outstanding. An analysis of standard valuation metrics reveals a highly distorted picture reflecting the temporary impact of high capex. The extremely high PE multiples, 30x to 63x, are a direct consequence of the depressed TTM earnings caused by the Blackrod project's associated costs and financing charges. Net earnings-based valuation is functionally useless at this stage of the capital cycle. Institutional E&P valuation typically relies on cash flow metrics. The price-to-cash flow ratio of 8.34 and the EV/EBITDA ratio of 9.46 are elevated but reasonable for a company that is nearing the end of a major transformative growth investment cycle. These cash flow metrics project future profitability and are the most reliable indicators of the market's forward-looking assessment. B. Analyst consensus and implied upside. The market valuation of IPC is driven almost entirely by the expected future cash flows derived from the Blackrod project. The analyst consensus average 12-month price target stands at $25.58. When compared to the current stock price of $15.79, this implies a substantial potential upside of roughly 62%. This significant disconnect between the current trading price and the consensus target demonstrates strong confidence from the street in two key areas: the successful accelerated delivery of Blackrod and the company's ability to generate the massive post-commissioning FCF required to justify the projected intrinsic valuation. The high uncertainty rating assigned by analytical models, 1, is likely a reflection of the execution risk and high financial leverage attached to realizing this substantial upside. C. Shareholder returns policy. IPC's commitment to shareholder returns is focused solely on capital appreciation through share count reduction. As noted, the dividend yield, trailing and forward, is 0%. This policy is appropriate for a company prioritizing the development of its core asset base. The firm actively returns capital through its aggressive share buyback program, NCIB, having returned MUSD 102 in 2020 alone. The resulting total yield of 7.59% demonstrates management's belief that the stock is intrinsically undervalued, making buybacks the most effective use of capital to enhance future earnings per share and cash flow per share when Blackrod starts delivering production. V. Risk assessment. A. Operational and execution risk. While the Blackrod project has been actively de-risked by the ahead-of-schedule update, the successful on-budget ramp-up to full Phase 1 capacity remains the single most important operational challenge. Any unexpected complications during the commissioning or ramp-up phase would directly jeopardize the forecast cash flow inflection point, delaying deleveraging and potentially triggering financial strain. Furthermore, the reliance on heavy crude oil, 53% of mix, maintains exposure to volatility in Western Canadian physical oil markets and associated pipeline transportation risk. B. Financial and commodity risk. The financial position has dramatically shifted, marked by the MUSD 435 net debt position. This leverage magnifies the sensitivity of the balance sheet to negative commodity price movements. Should oil prices sustain a significant drop, the already thin interest coverage ratio of 2.86 would quickly become a pressure point, potentially forcing a reduction in the capital return program or necessitating external funding. The short-term liquidity, while adequate, current ratio 1.18, provides little room for error if project delays occur or market conditions deteriorate. 8. Conclusion. IPC represents a highly asymmetric investment profile. High near-term financial risk due to aggressive leverage and capex balanced against massive long-term value in its resource base and the imminent commissioning of a major growth project. A. Synthesis of findings. The analysis confirms that IPC is a futures play, currently trading at cash flow multiples, P/CF 8.34, EV/EBITDA 9.46, that project substantial future profitability. Current negative FCF, MUSD -23 in Q3 2025, and depressed net earnings are recognized as temporary consequences of creating long-duration value through the Blackrod Phase 1 development. The critical evidence supporting the investment thesis is the confirmation that Blackrod is ahead of schedule, signifying that the period of maximum financial strain and FCF drain is peaking or has passed. The sheer scale of the 1.1 billion BOE contingent resource base provides a sustainable growth model far beyond the initial Blackrod phase. The successful mitigation of execution risk, coupled with the projected cash flow inflection point in the near future, justifies a favorable assessment of IPC's equity value. The significant disparity between the current price of $15.79 and the consensus target of $25.58 indicates that the market has not yet fully priced in the reduced execution risk and the substantial future cash flow stream. The firm is ideally positioned for capital appreciation as it transitions from a high capex development company to a high FCF generating producer capable of rapidly deleveraging and sustaining aggressive share buybacks.